Hello everyone and welcome back to our ongoing valuation series. Today, in this part, we'll be talking about the assumptions for valuation of a company. While we value a company, we make a model, and for that we have to take certain assumptions. We do so using Excel, and these assumptions help us to estimate the intrinsic value of a company. The key assumptions are: first, financial projections. It said that history repeats itself and so do the growth and trends. Assume that historical financial data provides you a reasonable basis for forecasting future performances. We include revenue growth, operating expenses, and capital expenditures. Second is discount rate. The risk associated with companies' future operations need to be accounted for. This is reflected by companies' weighted average cost of capital, taking equity and debt into consideration, and reflecting the company's overall risk profile. Third is perpetual succession. When estimating a company's terminal value, we assume that company will run for a longer period of time. We need a cutoff point treated for a perpetuity, assuming the long-term growth of free cash flows. Hence, a perpetual succession and growth rate is assumed. Next is capital structure. It is assumed that the capital structure, that is debt and equity combination, will remain constant throughout the life of the organization. A change in debt equity combination or capital mix can cause a change in the cost of capital for the organization. Next is market conditions. Market conditions will constantly operate under the premise that the current state of market and economic variables serves as a reliable indicators. These assumptions are heavily influenced by macroeconomic factors including but not limited to interest rate, inflation, industry trends. The next is no significant events. We assume that there are no major unforeseen events such as litigations, economic crisis, regulatory changes that could impact companies' operations during the forecasting period. To conclude, we keep in mind that these assumptions provide a foundation for our valuation, but the real world conditions are dynamic. Regularly reassessing and updating these assumptions is essential for maintaining the accuracy and relevance of the valuation model. If you have any questions or feedback on our videos, please leave them in the comments below, and don't forget to like, share and subscribe to our channel for more such videos. Till then, stay tuned for our next video on valuations.